more and more. We've also run a couple of hedge fund workshops over the past few months, and hedge funds can potentially offer a mitigation tool or become a mitigation tool for risk for clients. Somebody else summed it up very, very well the other day, actually said, yeah, hedge funds can actually get you to the same place or maybe a little bit better place, but with less squigglies. Is that true? Yeah, Kobus Kok from Fairtree, thank you so much.
Thank you, Eugene, and thank you, everyone. You've been very gracious with your time. If you want to leave, I would say, wait. Let me tell you something. A quote from a very scared guy. I'll talk you through the fixed income fund at Fairtree, and I'll specifically touch on some of the opportunities that we see at the moment. I'll make the case for the asset class, which I think some of my colleagues have already done, and also express how we go about in taking advantage from those opportunities. But first, at Fairtree, we have two fixed income teams. We've got a credit team, which is led by Paul and Louis. Some of you would be invested in some of their funds. But we also have a rates team, a duration team, and that's myself and Ian. We've been working together since 2016. We manage some long-only money, as well as some fixed income hedge fund money. And you would see that some of those strategies has been running for the last 15 years. And I know fixed income or hedge funds has become more popular recently, but some of the strategies and hedge fund strategies has been in this industry for a very long time, have been tested. And so I can attest to that as well. So what we try to do is look at the macro environment, look at inflation, the foreign policy, monetary policy growth, and see where there are opportunities on the interest rate curve where we can take advantage from dislocations, or where we can employ a certain view to take advantage from different points on different curves. Those curves typically in South Africa, and we've got three different curves. The FRA curve, which you typically express a view in the 1 month to 2 year space. So it's typically a monetary policy view that you want to express on that curve. Then we have the fixed income or the SAGB curve, which is from 186s to 2053s, the curves that we spoke about mostly from our previous speakers. And then we also have a swap curve, often used by the banks and the corporate hedges. And so we look at those three curves, and they may price different rates at different times, and there's often opportunities that you can take advantage from. So I'll give you some examples of just some of the main strategies that we employ. The first one is what we call a curve shape. So imagine the current bond curve is fairly steep, like we are seeing at the moment in South Africa, the orange line, and you believe, in your view, that the curve will flatten. Now, that could happen because the front end rises as the central bank continues to maybe hike rates, or it could be because the back end comes down as investors are pricing out say credit risk. So what you would do is, and I'm going to use long-short terminology, in the same way that you would talk about an equity long-short fund, you would go long a bond at the back end, so the 25-year or 2048s, and you would go short a bond at the front end, say the 5-year bond. In a similar way, you could employ a trade between the bond curve and the swap curve. So at the moment, and for the last few years, swaps have traded below bonds, which is a bit of not an anomaly in developed markets, but in emerging markets, we see typically swaps trading below bonds. But that spread in SA is a bit of an anomaly. It's quite steep. It was about 250 basis points just a few years ago. It's now about 130 basis points on the 10-year. And if you believe that there will be a contraction between those, you go long bonds, you go short the swap to take advantage from that move. So regardless of what happened to the overall curve in both these two examples, you can take money, or you can make money if you are right on the view whether the shape will change, whether there will be a spread compression between the swaps and the bonds. The last one is probably more straightforward. Also a directional view. We spoke about the reasons for why you want to be long bonds. But if you believe that bond yields will be rising, you could go short bonds, say at the 10-year, to take advantage from that as well. Okay, so what are the opportunities at the moment? And I think the first one we spoke about quite a bit, so I won't go through all the different details. But I want to emphasize the fact that we are moving to a 3% inflation target is probably one of the most significant economic reforms that we've gone through in the last 25 years. You would see here how we've struggled to get within the 3 to 6% band under Tito Mboweni. Jill tried her best, but she convinced the market that around 6% is the actual target, or the unofficial target. That's what the market believed. And then Lesetja had to come through and really try and communicate to the market, we want to get to 4.5%, and now more recently, 3%. Now, what are the implications, and why do we need to do this? First of all, if we look at South Africa's inflation target, relative to our peers, it's much higher, which means that inflation in SA is likely to run higher. Production cost and cost in SA is higher than our peers, which means that we are pricing ourselves out in terms of competitiveness when we try to export stuff and produce things for the rest of the world. Our peers have actually started at the same level as we, roughly at the same level, and have moved down over the last 2 decades. We are still at that 3 to 6%. That's why it's important for us to get to a lower level. The second big advantage is really the wealth effect that will have. Inflation is a tax on income. It's a tax on your current income. It's also eroding your savings. So if you have 10 million rands in a bank, saved for a day in, say, 20 years, at an inflation rate of 5.5% in 20 years, that would be roughly worth, in today's spending terms, 3.5 million. At a rate of 3%, that would be worth 5.5 million. So 2 million more. Good news is you could go on a holiday a couple of times more over the next 20 years without telling your kids. They will still get the same amount as they would have received otherwise. Okay, so apart from that, also we see that the borrowing cost is coming down. And as borrowing cost is coming down, the discount rate is coming down, which means that asset prices in general, if you use the future cash flow model, they should be rising. So it also has got a positive impact potentially on asset prices. So as the funding cost comes down, and we know that the SARP has told us that the neutral rate under this new inflation framework would be 5.5%. That's just the neutral. That's where the economy isn't overheating and there's enough jobs coming through to keep the unemployment rate stable, which means that it can still drop below that if we go into a weak growth environment. So I would say that is a significant benefit to the future funding cost of the country, but also, funding cost of what we are doing every day in terms of being economically active. There are some costs. Initially, the nominal GDP would therefore be slightly lower. There would be an impact, for instance, on our debt to GDP in the short term, slightly negative. Also, our primary balance would be slightly negatively, as you can see from this chart, in the first few years before the gains starts to get baked in. But that's a small cost that we have to pay for much larger economic benefits in the future. And I would argue we've paid the cost already. We've already paid a large amount of the cost that we are fearful of. The sacrifice ratio, we've paid that already over the last few years. That's why we haven't seen the growth that we're supposed to see, even though you've seen Eskom coming through. Economic policy and fiscal policy has been too tight. So, under the new inflation framework, we will see inflation rates drop. This is the orange line that the SARB is predicting inflation to get down to 3%. The black line is where they used to be under the 4.5%. We had the inflation expectations data out earlier this week. It's very encouraging to see that market participants are starting to see inflation going down to the lower 4s and potentially the upper 3s. That's all that the SARB needs to start cutting interest rates. And this next chart kind of shows what the market is pricing at the moment. The green line shows the FRA's 21s, 24s, which means what does the market think policy rates will be in 2 years' time. And the orange dot is the neutral rate. So the market says that we'll, and this is slightly old, it's a few days old, so it's come down a little bit, but the market thinks we'll get 1 or 2 cuts over the next 2 years. If we are right, and the SARB is credible in getting the inflation target down to 5.5%, or the inflation down to 3%, and the neutral rate is 5.5%, we could easily get below 3%. The market is not pricing that. So as a hedge fund, how do you take advantage from this? You go in by receiving this 21-24 or something in that area. It could be forward-starting swaps in the 1 year, 2 year space. You also get a decent carry from that, but you could use that to employ this view. You could marry this up with a view at the front end. If you don't think that the SARB is going to cut rates tomorrow, you could be paid at the front end to provide a little bit of a hedge. So you could be very nimble in exactly how you express your views. There are some concerns around administrative prices, and that's why it's very key that supply-side economic reforms continue. And luckily they are, because as they continue, the scope that ultimately administrative prices will come down eventually also increases, and we see how the energy availability factor is now close to 70%. Transnet is also starting to turn around slightly. These are small beginnings, they're slow, but at least they're moving in the right direction. So what are the next big opportunity that we see? We think it's on the fiscal front. If we look at the fiscal dynamics at the moment, and some of the speakers spoke about this, but I want to just focus maybe on the revenue side. Revenues are starting to rise. This is a 12-month rolling year-over-year growth of what happens to revenues in the country. And it's growing faster than inflation, 8.2% at the moment. Corporate income tax is 5.2% after it's gone through a bit of a tough time. Personal income tax is also at 11%. So what's driving this? One, efficiency at SARS, also tax compliancy, and we believe that corporate income taxes this year will surprise to the upside because of mining revenues. We see that our metal prices have gone up in price, and that could really be a benefit still to the budget. So we think that ultimately could potentially drive the scope for less issuance that could be announced, less bond issuance. So while the rest of the world is increasing issuance, South Africa could actually come out at the MTBPS or next year in February and say we could reduce our issuance. That would put some pressure on back-end bond yields to come down. And the spread between, I'm just using 2048s here, and 2030s has been almost 3%. And just a year ago, it was around 2%. And we could easily go back down to that 2% level if we announce a reduction in issuance. There's also the scope that we can get off the grey listing, and rating agencies are starting to talk about a more positive story. We could see some upgrades within the next 18 months. So there's a lot of credit risk, fiscal risk, that could be priced out of the back end of the bond curve. Yes, the front end has come down because it's pricing in lower rates at the front, but we think that the opportunity sits at the back end of the bond curve. So that was the second opportunity. The third opportunity, I would say, the level of bond yields is still high, even though they've rallied a lot. On the first panel, you can see just the all bond index. There's about 50 basis points before we get to the historical average, but we have to compare today's duration, which is about 5.5 of the ALB, relative to what we had in 2018, 2019, which was about 7-ish, which means that today you're getting compensated roughly the same by taking less duration risk. So if you adjust that for duration, there's actually more scope, we believe, for bond yields to come down. And then relative to emerging markets, there's still at least 100 basis points for us to rally. And this has further been driven not just by the local dynamics, but by the global dynamics. As Gavin said, as things deteriorate in the rest of the world, the marginal risk that you're taking by investing in emerging markets is reducing. And so investors are saying, look, do I invest in UK bond yields or in some of these emerging market bond yields? I'm taking a little bit of a bigger risk, but I'm getting compensated for this. And we are seeing flows coming into the country. And specifically South Africa, we've seen big bond flows. I'll show you this chart here. This is the foreign participation of our local bond auctions. Every Tuesday there's a local bond auction. Historically, about 30% of those auctions have been taken up by foreigners. The last couple of years, it's closer to 50%. Last Friday, we had a massive foreign inflow into the country. I think it was the biggest in the last 7 or 8 years. So we are seeing foreigners coming in as the dollar depreciates, as emerging markets is in a better position to cut rates than some developed markets because inflation isn't that sticky. Supporting growth, that makes the case not just for local bond yields, but also for emerging market assets in general. And here, we have a more directional view on bonds, so we will be receiving bonds at the belly of the curve. This is how we've done over the last few years in terms of performance. So this is performance as at the end of August, about 11.5%. If we include to where we are today, it's probably closer to 15%. Strong performance over the last 2-3 years. It provides you with an uncorrelated return. So it's not for every single investor. We believe it's best fitted to combine within a multi-strategy because of the correlation benefits and because of how it reacts to different macro environments.